The three letters to save your portfolio, what is it? DCA. This is a video I've wanted to make for a little while, but I think the way that the market is now, with quite significant falls in value in a lot of key indexes such as the S&P 500 and the Nasdaq, especially US-centric, and we're bordering on a 10% correction, people are losing their minds. It's in times like these people get worried, people start to think, what can I do to save my portfolio? What can I do to lower volatility? What can I do to benefit from the long-term movements in the underlying value of an asset, but not be stung by short-term volatility? And that is exactly what DCA does. For those who don't know, DCA stands for dollar cost averaging, and you could change that to any currency, dollar pound averaging if you want a DPA. But dollar cost averaging is a very widely known investment approach that I think is something used by seasoned investors. It's something that when you come into making investments, you may not think about or realize the benefit of, but all you have to do is have a couple of bad investments, do a bit of research, and it is one of the key investment principles that I think the vast majority of people agree with, and studies have shown is a very good approach. To put it simply, DCA, or dollar cost averaging, is making regular investments of a fixed amount over a prolonged period. So instead of, for example, you pay buy say £1,000 worth of, say, an S&P ETF, what you would do is buy £100 worth over, say, 10 weeks or 10 days. And what this does is lower the volatility. The way that this works and the thinking behind it is that if you buy at regular intervals, you are likely to buy the asset, underlying asset, the investment, when it's both overpriced and underpriced at different points in the cycle. If you buy it, for example, wake up one morning, lump all your money into something, the market at that point in time, the asset may be cheap or expensive, there could be a bit of news about to come that will rocket the price down or up of the asset, you don't know. If you buy it at regular intervals and multiple, it means that you are exposed to a lot more separate events, and that you will buy the asset, both after when something bad has happened, something good has happened, and what you can begin to do is benefit from the long-term and generally slow underlying increase of the value of an asset, rather than momentary, massive swings in its cost. DCA is directly opposes, should I say, swing trading. And swing trading is a higher risk form of trading. And I say trading as opposed to investing, with investing generally longer term, and trading mainly short term, such as day trading. Swing trading is about buying an asset cheap and then selling it when it's more expensive. For example, swing trading, what I might do is lump all of my money into one asset, and then if it goes up 1%, immediately take all of my money back out and aim to do that as a repeated cycle, which at times can work, but at times it can't work. And what it does is mean that your portfolio will be highly volatile, whereas DCA is a long-term approach. It is more investment-centric. It is not going to be short-term massive gains. It is for the long term. And for people that want to build long-term wealth, this is an approach that you should be using. I'll put some images on screen, but for an example, I held an amount in a crypto and blockchain ETF that a couple of weeks ago lost 20% in a day. And I also bought most of my holdings in that when it was at the absolute peak that it has been over the last couple of years. And what that has meant is that I've lost between 25 to 30% from memory value in that. As an example, if I had DCA'd, if I dollar cost averaged in over the last, say, year, for example, my losses would have been drastically reduced. But what I've done is bought at the peak and then slowly seen that decline, and then I've exited that investment. DCA will mean that you, in pretty much all circumstances, going to make less of a return. You will not be making vast returns from this, but what you will also be doing is stopping yourself from making a lot of losses. And over the long term, your returns will be greater, but you just will not be making massive short-term returns. That is not the benefit and the approach taken here. As this is a trading 2-on-2 focused channel, I thought I would segue into that and to say that DCA works perfectly with the use of pies, which there is a separate video on this channel about if anyone wants to watch that. But what pies allow through trading 2-on-2 and other platforms like eToro have similar things is auto invest. So for me now, what I've done is I've set up a pie of, I think, about 7 separate assets, and it trading 2-on-2 invests a certain fixed amount every single Monday, and it is set and forget really from my perspective. You can set the pie to rebalance. If one asset goes up and down, you may end up with different weightings to what you set. But it means what it means is I can start focusing on longer term trends, thematic trends, as opposed to trying to time the market. And as the old anecdote saying, time in the market is more important than timing the market. And the pies feature and auto invest is a great thing. It generally stops you worrying. It stops you focusing too much on your investments. You can set and forget and just benefit from the historic trends that we've seen in the market. Obviously, they are not necessarily going to continue, but what we have always seen in sort of key indexes is long-term growth in things like the S&P, and there's no real reason to suggest that will stop anytime soon. It's also important to say that when you dollar cost average in, and by in I mean buying investments, you should also DCA out as well. If you do this for the long term, you generally do not want to sell all of your holdings at one point. For example, if I go back to my crypto ETF that I held, I sold all of that after it was down about 20% in one day. And then last week, Trump adding Bitcoin and cryptocurrencies to the reserve, it then gained 12% overnight. So I have lost out of that 12%. If I had DCA'd out, I would have lost, maybe if I had taken a quarter out with a minus 20%, I would have then been able to take another 25% out at the higher rate. It's these sorts of things, it just reduces the volatility massively of your portfolio. This whole auto invest dollar cost averaging approach also, I think, takes some of the emotion out of investing, which is a key thing that I think as a beginner investor especially you succumb to, is being emotional, being worried, being over eager when you see things spike, and being overcautious when you see things drop. This approach, especially if you stick to it and if there's a set and forget, means that you can just trust the system, lower your volatility, and you won't be caught out and make the drastic errors that can be really impactful on your portfolio from being over emotional and being too rash. I hope this was a useful video. DCA is a great technique, I think, for a lot of people. If you have any questions about it, please put them below, and any other feedback and comments on the channel, please put them in the comments section. The support has been really great, and I really appreciate everyone's support for this channel. This has been, we're now doing once a week weekly videos. I hope to increase that, but all the support is really appreciated. But in saying that, it's been Harry from HTL Finance. I'll see you next time.